Well, the U.S. economy grew at a faster rate in the third quarter than first estimated. Data released by the Bureau of Economic Analysis shows the country's GDP grew at an annualized rate of 3.2% between July and September. That's revised up from the 2.9% pace reported last month. I want to bring in Jesse Wheeler to discuss this report. He's an economic analyst at Morning Consult. Hi there, Jesse. So what did you take away from this data?
The data released today was, good news for the U.S. economy, of course. As you say, it was revised up from 2.9 to 3.2% for the Q3 real GDP figures. This is actually a second upward revision of that initial data release we saw last month. And it comes on the back of an upward revision in that critical component, consumer spending. We also got a positive data release in the labor market today, with jobless claims remaining very low. So overall, these are all very positive signs for the U.S. economy. Despite these constant fears of recession risk, as we move into 2023.
It is interesting. The newest data did show higher levels of consumer spending as well as business investment. So do you expect fourth quarter data to reflect that as well?
So consensus, among economists is that, that growth will slow down from 3%, closer to maybe 1% growth for Q4. Here I would mention that, it takes a kind of a long time for, interest rate hikes that we've been seeing over the course of the year to make their way through the economy and to impact demand and to tighten financial conditions in a way that businesses pull back investment. But we're seeing that that is starting to happen. We're seeing in our data here at Morning Consult as well, where we're pulling small and medium-sized business owners and directors, and they're saying that they're already facing tighter financial conditions, and it's causing them to pull back on financing and potential hiring and investment moving into next year.
Well, does this give you a sense that perhaps the U.S. may not be headed into a recession, as some economists are predicting?
Certainly, the data that we see today, growth over 3%. A very strong labor market with unemployment claims, still near, these, decades lows, strengthens that argument that the U.S. economy is proving very resilient, and that we may be able to avoid a recession after all. But here I would again emphasize that fact that it takes a long time for interest rates to fully make their way through the U.S. economy. We're already starting to see it in the most cyclical of sectors like housing and construction. You're already starting to see a big pullback. And when you talk to firms and to decision makers at companies, they're really starting to go into this recession mode and pull back. And then also, consumer spending has held up to a certain degree that so far this year, but with inflation continuing to outpace wages, we expect that may be less sustainable, moving into 2023. So I'd say the economic outlook still remains pretty grim despite this optimistic news in the data releases we saw today.
Just to dig in a little bit more on consumer spending, shoppers cut back on spending in November compared to October ahead of the holiday season. So what does that tell us, Jesse, about the current state of the economy?
I think what we're seeing there is, the impact of, inflation outpacing wages. So over the course of this year, wage growth has been very strong. However, inflation, has, peaked at 9% and is still 7%, faster than the rate that incomes have increased for most households. Households went into this period with higher savings and higher rates of savings coming out of the back of the pandemic. However, both of those have started to come down, and we've also seen credit usage start to come up to maintain these levels of spending. However, this is largely unsustainable, and going into the holiday season, more and more families are needing to make trade-offs and potentially pull back on their level of overall spending. And we see that we saw that in those November numbers that you mentioned.
All right, Jesse Wheeler. Jesse, thanks so much for your insight.
Thank you.